Welcome everyone. I'm Nicoletta Centofanti, LSFI Sustainability Advisor, and I will be moderating today's event on impact investing, organized by the IFC, the International Finance Corporation, and the LSFI, the Luxembourg Sustainable Finance Initiative. Impact investments are generally defined as a particular type of sustainable investments made in companies or organizations with the explicit intent to contribute to measurable, positive, social or environmental impact, alongside a financial return. Despite increased interest in impact investing and a growing number of product launches, there has been a lack of common discipline for how investors should manage investments for impact and the systems they need to support it. This has created complexity and confusion for investors. Also, when it comes to impact investing, many questions arise around the operational implementation of the investments, the reporting metrics and measurements. For example, is there a common approach for how investors should manage investments for impact? What steps can support the overall integration of the impact dimension within the investment progress? Just to mention a few. Today, we will deep dive into this topic and try to answer these questions. Our expert will first present the operating principle for impact management developed by IFC in consultation with a group of asset owners and managers. Then we will have a panel discussion where we will learn more about the impact investing opportunities and different strategies, and also on how to manage, report, and measure impact. To wrap up, there will be a Q&A session. If you have any questions, please write them in the chat and we will cover them at the end. Before we start, I would like to give the floor to Pierre Gramegna, Luxembourg Minister of Finance, and John Gandolfo, Vice President and Treasurer of the IFC, who will help us set the scene. Let's listen to them.
Excellencies, ladies and gentlemen, it is a pleasure for me to be participating to this conference on impact investment that is organized by the IFC and Luxembourg Sustainable Finance Initiative, an initiative that's very close to my heart and to which I dedicate a lot of time because I just believe in sustainable finance, but today it's become more than a belief, it is a must. The pandemic has underlined that probably better than anything else. It has acted as a catalyzer of the emergency of climate change issues. And Europe has had a coordinated answer to this pandemic and has decided to build forward better by focusing on the digital strategy on the one hand, but even more so to the climate change challenge. As you probably all know, Europe has decided to launch a resilience and recovery fund worth 750 billion euro, where more than 30% have to be dedicated to investments that make a difference, that have an impact on climate change. Luxembourg has supported that from the very first day, and we do the same in our country, having, for example, recently put into place a framework for a sustainable bond issued by the state of Luxembourg. So a sovereign bond that is sustainable both in terms of environment and social, and it was the first such bond issued by a AAA country and the first such issue by a European country. This being said, let's face the reality, social bonds and green bonds are still not the majority. We've passed the threshold of 1 trillion of green bonds emitted since the very first one in 2007 by the European Investment Bank, but this is still far less than 5% of all bonds issued. So there's a lot of work to do there. And the IFC is an important actor in this field. We support the IFC's advisory efforts in this field to the tune of $40 million over the last 3 years, and we will continue to act as a very important partner in this context. I would also like to say that it is quite important to involve the private sector in this, and that's why we are also supporting the Amundi Green Fund in this context. This Amundi Fund being listed at the Luxembourg Stock Exchange. Because let's face it, it's not enough to have public support for climate change and sustainable finance efforts. We also need to crowd in the trillions of the private sector. The European Investment Bank is a great actor in this. We, as Luxembourg, are doing this also. We have launched with the EIB a climate finance platform in 2017 in order to crowd in private investment, especially in emerging markets. We have also done a climate finance accelerator in Luxembourg. These are examples that you probably can touch upon in the discussion that you will have today. I would like to congratulate the organizers for putting this together. Wish you a good conference and hope that you will have fruitful discussions.
John, the floor is yours. Thank you.
Thank you very much, Nicoletta. Ladies and gentlemen, it's my pleasure to join this event on impact investing and to add what we just heard from Minister Gramegna. Special thank you also to the Luxembourg Sustainable Finance Initiative for partnering with us to host today's discussion. We're here today to learn from one another and to deepen our knowledge about impact investing. I have no doubt that you will be in good hands with my colleagues who will speak about IFC's experience as an impact investor, as well as with the other practitioners who will share their insights. As we get started, let me frame our discussion by sharing a few important numbers that capture both the challenge and the opportunity that we face. The global community is experiencing a $23 trillion financing gap to achieve the Sustainable Development Goals by 2030. And that's just 9 years away now. In the past few years, impact investing has emerged as a significant opportunity to mobilize capital into investments that target measurable positive social, economic, or environmental impact alongside financial returns. A growing number of investors are incorporating impact investments into their portfolios. Many are now adopting the Sustainable Development Goals and other goals as a reference point to illustrate the relationship between their investments and impact. A new IFC report shows that impact investing continued to draw strong investor interest in 2020, with 2.3 trillion invested for impact. And that is even amid the turbulence caused by COVID-19. While the total invested for impact is growing, this number is now just 2% of global assets under management. So clearly, impact investing needs to scale up further to reach its potential. For over 6 decades, IFC has been at the forefront of impact investing in emerging markets. We were founded in 1956 with a mandate to invest for impact. Over the years, others joined us in this journey to deliver not just financial returns, but also development impact. With the establishment of the operating principles for impact management, which IFC helped create in 2019, we seek to work with a much broader universe of private investors, development finance institutions, insurance companies, and sovereign wealth funds to mobilize the trillions of dollars necessary to achieve the Sustainable Development Goals. IFC is committed to using our innovative platforms to make it easier for investors to mobilize private capital to achieve the world's development goals. So I'm delighted that we have come together to talk about impact investing and how we can more fully make its promise a reality. The pandemic focused our attention on the things that matter. Impact investing gives people a way to put their money behind their convictions for greener, more inclusive, and more resilient communities. As one of Europe's leading financial centers and the continent's leader for responsible investing funds, Luxembourg, even virtually, gives us a fitting venue for today's discussion. Thank you again to the Luxembourg Sustainable Finance Initiative for hosting us. I wish you a very fruitful conversation today on finding opportunities and managing strategies for impact investing.
Thank you very much for these introductory words, showing the importance of impact investing. It's fundamental to shift capital towards investments which can generate a positive impact, and therefore to have the appropriate tools to measure the impacts achieved. Thank you very much, John. Thank you, Pierre, in video. As mentioned, IFC launched the operating principles for impact management in April 2019 to bring credibility, discipline, and transparency to impact investing. To further explain what the impact principles are about and what's their goal, I will now give the floor to Neil Gregory, Chief Thought Leadership Officer of the IFC, and Diane Damskey, Head of Secretariat of the Operating Principles for Impact Management. Neil, Diane, the floor is yours. Thank you.
Great, thank you, Nicoletta, and very glad to be with everybody on this webinar. I'm going to use a few slides to help set the scene for why we developed the impact principles, and then Diane will talk about the principles themselves, and we'll close with a discussion on impact measurement. So let me pull up my slides onto the screen. Give me a minute. The impact investing space has really been developing quite rapidly across the world, and has really received an additional boost, I would say, over the last 18 months that we've been experiencing the pandemic. I think this has brought to everybody's attention the importance of addressing both environmental and social issues, and as we see more extreme weather events and other things that remind us of the urgency of climate change, that is also attracting investor attention. So already there's a large part of the market that is investing with attention to environmental, social, and governance risks, what we call ESG investing. But increasingly, investors want to go beyond just managing ESG risks and actually make a positive contribution to improving social and environmental outcomes. And so as investors pay more attention to achieving the Sustainable Development Goals and climate change, so they are increasing their demand for assets and products that allow them to invest for those goals. In response, the financial services industry is developing new funds and products and assets which meet that investor demand. And so we've seen a scaling up from what was once a very small niche is now becoming mainstream, and most large investment banks and asset managers are now offering impact products. In a few years, we've gone from seeing impact funds being launched for maybe $100 million to now $1 billion or more. So that scaling up is happening as we speak. Let's go to the next slide. So what we can see in our latest report on the size of the market is that the market is now over $2 trillion, and it's composed of a mixture of private investors and public institutions like IFC, who also invest for impact. Some parts of that market has all the systems in place to measure and manage the impact, but there's also a larger part of the market where investments have a stated intent for impact, but we don't know that they have all of the impact measurements and management systems in place. So the part that you probably think of first when you think of impact investing is the privately managed funds, which have the measurement systems in place. That's still a fairly small niche, $286 billion. So, that's barely 0.1% of total assets under management globally. So it's very small. But if you add to that the $349 billion managed by DFIs, institutions like IFC and national development banks, you get to a total of over $636 billion, which has all of the elements of impact investing in place. In addition to that, there's another $1.6 trillion, which has intent for impact, but maybe hasn't put all the measurement and management systems in place. So it gives you a sense of the progress that we've made, but there's still a long way to go. If you add that together, then we think the market at the end of 2020 is somewhere around $2.3 trillion. This is starting to become a significant asset class, which is attracting the attention of the financial services industry, I'm sure in Luxembourg as elsewhere, but still a small niche in the context of global capital markets of over $200 trillion under management. But we expect this to continue to grow rapidly given the investor interest. So if we go to the next slide. What we're seeing over the last couple of years as well is that impact investing is shifting towards having more of a global focus, and particularly in emerging markets focus. A lot of the initial impact funds were focused on domestic social issues or environmental issues, but more of the new funds that are being launched have an emerging markets or global focus. Next slide. So what's holding back the market from growing more rapidly? So the first concern of investors is that most investors who are interested in having an impact also want to ensure that they can continue to get a comparable financial return to other assets. And so that was a question mark in the early days of impact investing. But as investing scales up and you get more mainstream asset managers developing impact products, you're seeing more funds which are investing with the intent of achieving commercial returns as well as measurable impact. There was a lot of uncertainty in the market about what really distinguishes an impact fund from a sustainable or ESG or responsible investing fund. And Diane will talk in a moment about how the operating principles of impact management have become the standard for distinguishing what is an impact fund or institution. In a number of markets, there are regulatory barriers, particularly facing institutional investors, particularly concerning the interpretation of fiduciary duty, which leads some of them to hesitate to explicitly consider impact as part of their investment strategy. Some countries, I think, have gone further than others, including some EU countries, in encouraging institutional investors to think about sustainability as part of their fiduciary duty, but there's more to go in many countries to get regulators comfortable with allowing institutional investors to invest for impact while also pursuing their financial goals on behalf of their beneficiaries. And finally, there's also a lot of confusion around how to consistently measure and report on impacts. And so beyond the operating principles, we're also part of the coalition that's working to develop common frameworks and metrics for measuring and reporting of impacts, which will help investors more clearly understand the impact they're having across all of their portfolio. So let's go to the next slide. So if we can address these bottlenecks, this is what we think that the market can grow to based on analysis we did a couple of years ago on the appetite of investors, where we looked at what is the appetite to invest for impact with and without the opportunity to earn a commercial return at the same time, and looking at it in both public and private markets. Today, most impact investing is in private markets, and that's where it is easier to demonstrate that you're making a contribution to impact. But on the other hand, most invested assets are in public markets, which offer greater liquidity and transparency. So there's a bit of a mismatch today. So what we see on this slide is that clearly the appetite from investors would be larger for impact investments if they can get products in public markets that are liquid and tradable, and also quite understandably the appetite is larger where they can obtain commercial returns. So for the market to grow, we think it's important that we continue to build a track record as impact investing matures to demonstrate that impact investments can and do achieve commercial returns. And it's also important to develop products for public markets as well as private markets. Let's go on. Let me pass to Diane for the next few slides.
Thank you, Neil. So as Neil had said, the operating principles for impact management were launched a few years ago, and they were created as a standard for impact investors. What they do is they provide a framework for the impact management systems that can ensure that investors are incorporating impact throughout the life of an investment. And the key components, again, are contribution, are intentionality, contribution. You must be able to state why your capital makes a difference to the impact achieved, and also the measurement of that impact. So they were launched about 2.5 years ago. And what we've seen since the launch of the impact principles is that there's now a clear definition of what it means to be an impact investor. And we see much more discipline and transparency in this market, and that is due to the requirements of the signatories. So once you become a signatory to the impact principles, you must, on an annual basis, provide a public disclosure statement which describes how your impact management systems and processes align with each of the 9 principles. In addition, there's the Principle 9, which was considered key to reducing the risk of impact washing, which was becoming an increased risk. Principle 9 requires this disclosure, and it also requires on a periodic basis, which I would say on the average is every 2 to 3 years, of an independent verification affirming that you do have a system that aligns with the principles. So this independent verification has become, and we have Christina Leonhufvud that's also going to be available later for questions. This independent verification has become a very important piece of the impact market, but we are seeing that this is becoming a trend in other markets because you can state what you do, but having some independent party reaffirming this is really helping create discipline in these markets that have been growing and developing. Now, we have 137 signatories as of today, and right now, from the publicly disclosed disclosure statements on our website, we have over almost 420 billion in impact assets that currently align with the impact principles. Now, some signatories have not yet provided a disclosure statement, but we've seen a huge increase of almost $100 billion from last year in impact assets that are aligning with the impact principles. So we do see that it is an important catalyst for this market, and it's also very important to increasing the transparency and discipline. The signatories, of which you will hear from a few today, they really see themselves as leaders in this market, and they are keen on helping shape the future of this market, be it in measurement, be it in how do you assess impact. And we are also increasingly talking about how do we coordinate with all of the different regulatory issues that are coming up on the corporate reporting side and making sure that we are all moving in the same direction. I would like to mention one thing, that the German government earlier this year did enact legislation that requires any German-based impact fund that wants to declare itself as an impact manager must in fact be a signatory to the impact principles. So we are seeing that this is becoming a very accepted standard globally and is helping to build this market.
Thanks, Diane. So I think let's go through a couple of slides just to illustrate what you were talking about. If we can go to the next slide. So for those who may not be familiar with operating principles in detail, this slide shows you the 9 principles, and you can see that they cover the whole investment cycle from setting your investment strategy, to origination and structuring, to how you manage assets in your portfolio, all the way through to exit in the case of equity investments. And the principle 9 that Diane was talking about, you can see that at the bottom is really cuts across all of this. You need to both disclose as a signatory in a public disclosure statement how you're implementing each of the other 8 principles, and have the independent verification that Diane talked about. Next slide. And so this just gives you a sense of the diversity of the signatories that we now have. I think the numbers even now are slightly higher. I think now it's 137 signatories and $480 billion in impact assets. And it's a mix of public and private asset managers and some asset owners, which we think is important for driving the market forward. And as you can see, there's a number of signatories already from Luxembourg, and we hope to see more asset managers from Luxembourg adopt the principles. And many of these signatories already published disclosure statements. You can read all of these on the Impact Principles website, and it's a great resource for learning more about how your peers in the industry are actually managing the impact in practice. And more than 70 independent verifications have been conducted so far. Next slide. So this just gives you a sense of the global diversity of impact signatories, and I think this reflects the market as a whole. Impact investing is not just something which happens in Europe or in advanced countries, but you see it really developing across all regions of the world. Next slide. And so beyond the operating principles, which really create this clarity about what it means to be an impact investor, and the transparency of knowing how your money is being managed for impacts, investors also want consistency on how impacts are reported. So together with more than 50 of the signatories, earlier this year we launched a set of joint impact indicators which provide a common set of metrics for measuring 3 key dimensions, cross-cutting dimensions of impact: gender impacts, impacts on job creation, and impacts on climate. And the climate metrics are aligned with TCFD and other climate frameworks. We expect over time to develop further harmonized indicators of impact, and we see this then as feeding into the global discussions on corporate sustainability reporting with IFRS and the proposal for an International Sustainability Standards Board and the EU taxonomy. And over time, we hope to work towards a system where corporates are routinely reporting on key impact indicators of this type, which are needed by impact investors to understand their impact. And then to the last slide. So just to let you know that there's more resources online to dig deeper into any of the topics that we've covered briefly. The Creating Impact report gives a lot more detail on how investors actually invest for impact and the different strategies. The Growing Impact report contains a set of case studies from signatories of how they actually manage for impact in practice. You can see there Investing for Impact is just published a report on the size of the impact investing market in 2020. And finally, you have the link there to the website for the operating principles for impact management, which is also where you can find all of the disclosure statements and all the information about the current signatories. So I'll pause there and pass back to Nicoletta. And sorry for the technical glitch, but we got there in the end. Thank you very much.
No worries at all. Thank you very much, Diane and Neil, for your interesting overview of the impact principles, also the increasing signatories community and the size of the impact investing market. To continue today's discussion, I would like now to look into the practical side of impact investing, how to find opportunities, what strategies to follow, and how to measure the real impact and track progress. We will examine it from different perspectives, also showcasing the experiences of 2 signatories of the impact principles. Today, we'll have with us Adriana Balducci, Associate Director and Head of Advisory Services at Innpact, Andrea Engel, Head of IFC Brussels Office and Country Manager for the Benelux, Cyprus, Greece, and Portugal, Claudia Itai, Research Associate in the Life Cycle Sustainability Assessment at the LIST, the Luxembourg Institute of Science and Technology, Marie Pouot, Head of Impact Management at Bamboo Capital Partners, and Shade Duffy, Director of Impact Management at AXA Investment Managers. Thank you all for being with us today. I would like to start with Shade, Marie, and Andrea. You three have extended experience in impact investing using the impact principles. Shade, you're leading the impact management and measurement practice for the AXA Investment Managers. Could you tell us why did AXA IM decide to focus on impact investing, and what's your impact investing strategy?
Thank you, everyone, and what a great opportunity to be here today. And thanks for asking that we participate in today's discussions. So just quickly, maybe take a step back. So we started our impact strategy in 2012. Now, for anyone that knows AXA and AXA Investment Managers, you know that is relatively recent. But what we really are is a broad-based mainstream asset manager. We have over 800 billion assets under management, and we've been a house that's really integrated responsible investment considerations. And I'm talking about this to just kind of give you a sense of the distinction we put on impact. So 800 billion in assets, ESG considerations integrated. We consider ourselves to be responsible investors. But when it came to, in 2012, we decided to create a distinct strategy that was going to focus on impact. Because to us, impact investing is about being intentional about contributing solutions to societal challenges. So while other investments may in some way tackle those challenges, impact investment is a direct focus on the challenges and using our investment know-how to put together solutions that can address those challenges, but we can also take a step back and really measure the extent to which we have contributed, but also, let's be realistic, or not contributed to the solutions that we wanted. So for us, impact is beyond ESG, is really focused on solving challenges and being intentional about the solutions we bring, measuring those the results of our interventions, but also reporting on it are critical aspects of impact investing. I'll just stop there and pass on to the next.
Thank you, Shade, for this overview. Marie, you're leading Bamboo's impact approach, also collaborating with the investment teams to deploy impact management. Could you explain us Bamboo's strategy and what impact teams do you focus on?
Thank you very much. Thanks for the opportunity. And Bamboo actually was created to do impact investing. So in our case, we do nothing else. Jean-Philippe de Scrovel, who is our founder, also co-founded 20 years ago Blue Orchard to do lending to microfinance institutions. And then he created Bamboo in 2007 to do private equity for microfinance institution originally. And then we expanded our investment teams to other sectors. And I very much like the definition that Shade has provided about the intentionality of investments. And for us, our impact positioning is to invest in companies that provide essential products or services to low-income populations. So this is really our positioning in the world of impact investments. And we started with the financial inclusion sector, and progressively we developed and we went into other areas such as solar energy access, which had a very important potential for both social impact and also environmental impacts, and other sectors such as healthcare access, with, for instance, low-cost healthcare clinics and hospitals chains in developing countries. Recently, we developed our expertise in agribusiness and smallholder farming, and we launched a new fund dedicated to this. and gender investing. So we focus on emerging and frontier markets. We invest in SMEs, and we target the so-called missing middle segment, where the financing needs are high, and there is unmet financing needs, and also the social impact potential is very high as well. And although we have historically mostly focused on social impact, we also invest in companies that have a positive contribution to climate change in terms of mitigation or adaptation. And we see a natural-based solution as an important and fast-growing segment for the impact investing industry. And we are currently exploring options to invest in natural-based solutions, especially together with our new strategic partner, Palladium Group, which has experience in this sector. In terms of investment strategy, we invest both in private debt and private equity. And we have a presence in Asia, Africa, and Latin America. Thank you very much.
Thank you very much, Marie. Shade, can you let us know more about the geographies and the asset classes, as well as the themes you focus on?
Of course. So similar to Bamboo, we focus on the private capital space. So we invest in private equity, private debt, alternative assets. We have global investors. So we have, and I think having a global view, it's very material to our definition of impact, because we want to take our capital and our interventions to where the challenges are. And to a certain extent, we've always debated extensively that we cannot see ourselves as real impact investors if our capital does not seek interventions that affect global populations, irrespective of where they are. We want to go where the needs are and provide the solutions. In terms of themes that we focus on, so we have an environmental pillar and a social pillar too. In terms of our environmental pillar, we're very big investors in natural capital. We really believe in the role that nature can play in terms of climate change mitigation and adaptation. And let's not all forget all the biodiversity aspects that are equally important. We do resource efficiency, but we also focus on resilience, which is not surprising given the insurance heritage of our parent company. On the social side, a big focus again for us, it's financial inclusion. We really believe that, you know, we have to give people the ability to prosper. We have to give people the financial tools to meet their needs. And on the other side, we also have to give them solutions for health. So a key focus for us on the social side is health and wealth, because we believe these are two fundamental building blocks for human progress. So those are just a quick summary of what our focus is. But similar to Bamboo, to really, I would say our focus is also really on the underserved. You know, who are the people and where are the regions that don't have the solutions but need it? And then to use that also as an investment lens to overlay our strategy.
Thank you both, very inspiring. I would like now to bring in the IFC perspective. Andrea, you have extensive experience managing the relationships with the EU and European stakeholders. How has IFC invested for impact with European clients over the years?
Thank you, Nicoletta. I hope you can all hear me. I seem to also have some Wi-Fi issues. Before I answer your question, I just wanted to say how happy I am to be part of this discussion and to be on an all-women panel. So I noticed earlier when the photos came up, and that always makes me even happier to be on a panel. But now I will get to your question. So indeed, as you all know, IFC, we are essentially a private sector focused emerging market investor. However, a lot of what we do in emerging markets, we do it with and through our European partners, be they corporates, financial sector, other investors of all types and sizes. And to do this, we have offices here in Europe, in Brussels, in Frankfurt, London, and Paris, that manage the relationship with 27 countries. And these are countries in which we are no longer investing, but where we actually source a lot of our investment. And the examples mentioned earlier, you're all European players. These are great examples of the type of investment that IFC also loves to support, and these are core to our mandate. European investors of all types are actually very important to us. In a typical year, it can range from 25 to 35% of our global kind of investment volume, what we do with European investors. In the last fiscal year, which for IFC ended end of June of this year, about a quarter of our investment were with European players. That equates to $3 billion of investment. That was done with, as I said, it could be corporates, financial sector, different types of investors. So that's obviously is a large number, all going to impact in emerging markets. And I wanted to also just illustrate what this 3 billion means in terms of impact. So from these 3 billion, 43% were in climate-related investments in emerging markets. A bit over 20% went to the most fragile and poorest countries in the world. So really, when we as IFC, we're looking for impact, obviously we cannot do it alone. We always have to do it with our clients and our partners. And so these are some of the numbers and some of the impact that we are able to achieve. I was going to illustrate and use the same example that the minister used to just give you an example of what we do. And I also had chosen that obviously it has a lot of angles and a lot of relevance to a Luxembourg audience. So I'm not going to repeat everything he said, but I'm just maybe going to find a few angles that he didn't mention. And that way I can also thank some other partners that have been key for us in this initiative. This is the Amundi IFC Green Bond Fund, which is a 2 billion initiative. It is listed on the Luxembourg Stock Exchange. The Luxembourgish government is supporting the technical assistance that we do in relation to this fund that is really trying to promote green bond standards in emerging markets. We train emerging markets bankers and financial sector executives, etc., through the support that we get from Luxembourg. And again, there too, the Stock Exchange of Luxembourg was instrumental in helping us deliver some of this training. So I'll stop here, and I look forward to the continuation of the discussion. Thank you.
Thank you, Andrea. Of course, these numbers are increasing, but we would like to see the increase even higher, right? So what co-investments and partnership opportunities could increase the volume of impact investment flowing towards emerging markets?
Yes, no, that's key. Of course, there is an ever-increasing amount of capital, right? Looking for impact, and some of the numbers that were mentioned by John and by Neil earlier. These are huge numbers, but obviously there's much more potential. And at IFC, really, one of the things that we see as core to our mandate is how best we can mobilize others to come alongside us into emerging markets. We have different ways of doing that. So one of which is simply through the way that we operate, which is a very decentralized model through a network of offices that we have on the ground, where we have staff that knows the local conditions, that is close to the private sector, close to the government, and can really be a partner to the private sector. So that has been a successful approach that we use. And then obviously we work closely with them here in Europe, for those that might not know us as well yet. In addition to that, in IFC, we are always trying to see how we, as I mentioned, mobilize others. So it's not so much about maximizing our own account financing. It is really about bringing others in. Typically, we, on average, do less than 20% of a transaction that we are investing in. And so this is to leave space for others that we, through different channels, try to bring into our transactions. One is through our syndications platform that is very well established and well known, where we work with a long list of European commercial banks. We also bring our other DFIs into these transactions. And then we have, in more recent times, also been trying to come up with instruments and tools where we can attract other types of investors, one of which is institutional investors, for which we have developed very targeted vehicles, one of which is the IFC Asset Management Company that really looks at equity co-investment opportunities. And then we have another vehicle called MCPP, which does the same for long-term debt. What it essentially does is offer a portfolio approach to institutional investors that allows them to reach the size that they're looking for. And then finally, I should mention, and that's quite important, and I'm sure you're going to hear more about this in the future, which is kind of the new strategy or the newest part of IFC strategy, which we call upstream. By that, we mean actually trying to catalyze more bankable investment opportunities of all types and of course all sectors in all of our countries by becoming engaged much earlier. So we're moving away from being just, you know, an investor to actually trying to unlock these opportunities. We have staffed up quite significantly in this regard and have had some great results. This could mean everything from, you know, looking at financing environmental study to tackling a technical issue that is holding up a project, to bringing in concessional finance to de-risk. So really the solutions are quite varied and very adapted to the needs on the ground. As I said, we've had good, this is a quite recent strategy, but we've had good initial results. In the last fiscal year, it generated for IFC and our partners and co-investors that I mentioned earlier, 2.4 billion in investment opportunity. And then we have actually quite a large pipeline that I'm going to mention, which is 22 billion in co-mobilization. So obviously in such a pipeline, it doesn't, you know, things can fall away, but we are very happy to see that we were able to triple it in 1 year. And upstream has a 3 to 5 year horizon. So we are in it, you know, we have skin in the game. It's a long-term proposition, but we also see that if it doesn't translate into something concrete within that time frame, it will be dropped so that we can move on to the next thing. So, you know, hopefully, you know, that will grow. And as I said, it basically generates opportunities for all investors. The point is not just for IFC. So thanks, Nicoletta.
Thank you, Andrea. Well, it seems there are really a lot of opportunities, and we're looking forward to see this volume increase further then. I want now to go back to Shade and Marie, sorry. Shade, in your journey towards impact investing, can you tell us what are the main challenges that you have been facing? And if, in case, you can share also some lesson learned that you would like to share with the audience?
So everyone always thinks that the main challenge is in terms of impact, because you're looking for opportunities, at least for us as mainstream institutional investors. We want financial returns, risk-adjusted financial returns, but at the same time, we want credible impact. And we have to find investments that work in lockstep. So a lot of people think that, and there are aspects of it that are true, that finding investable opportunities is the biggest challenge. I would say it's one, but I would say it's not the biggest. I think what we found as the world has bought into the spirit and language of impact, and everyone wants to align, whether it's because the SDGs are driving it, regulations are driving it. In the EU, we have the taxonomy, is that we really now have to be focused on the credibility and rigor, which then, of course, will lead to the results of impact. And that, for me, is the constant challenge, that when we're in a world where there is a lot of money wanting to drive change, a lot of opportunities seeking to be part of that journey, we have to be focused on making sure that ultimately that the promise we're making to our beneficiaries, and when it comes to societal issues like climate change, that we're actually channeling our investments to the right investment opportunities. So credibility and rigor, for me, are the challenges that we're constantly having to consider. Because right now, maybe at the early stages when we were looking at impact investing in 2012, I may have said, you know, the pipeline, you know, there are lots of initiatives. You know, one was just mentioned about IFC upstream, where there's a lot of catalyzing factors to bring investment opportunities. But now we actually have to ensure we actually have to be focused on the results we ultimately want, because impact investing is not just about investing. It's about making investments that have a visible, tangible change to societal challenges. And a lot of my focus now is on that part. Are we doing today what will deliver the results for tomorrow?
Thank you, Shade. Following what you just said, you mentioned discipline. So it comes to my mind, really, it's one of the key, let's say, reason why the impact principle, let's say, are here. Can you tell us how the impact principles are helping you in this journey?
So the impact principles is a collaborative initiative that we have needed for a long time within the impact investing sphere. And we've needed it because, impact investing has developed organically. But what we've needed is a guiding set of initiatives that allows, investors that want to be active and also credible in this space to share knowledge, to learn, and to do so in a transparent manner. It's brought about a degree of collaboration, so what if we say impact is about intentionality, that it's not about looking at your end results, but looking at where you started in terms of what's the challenge? How do I allocate capital? What the impact principles have done is put, in a way that's never been done before, a set of guidelines that every investor, whether experienced like us in this space or just new, but really wants to do impact credibly, it takes you back to what intentionality is. If you're starting in this journey, what is your strategic objective? What do you want to achieve? Have you really thought about the contribution you can make? What resources can you bring? And then after all of that, can you really credibly make the claims about the results that you're reporting on? And to do that, get someone else to look at your report. So I think for us, that is exactly what the impact principles have done. It's shared learning, but it's also a very important building blocks in terms of collaboration and rigor.
Thank you very much, Shade. Marie, now I would like to know about bamboo challenges and any lesson learned you would like to share with us.
Thank you very much. So I also agree that, frankly, deal sourcing is not the major challenge. At least for us, we work with a full ecosystem of various partners and networks. And there is a lot of opportunities for very impactful companies that need financing. So the deal sourcing is not that much the major challenge. However, for us, we have a strong challenge in the fundraising. There is still a high perception of risk from potential investors in the geographies and areas that we are investing in. And also, I would say that there is something that is related to liquidity as well, because the need for relatively long-term investments, especially when we do a private equity investment, is still a challenge. And for some investors, it's something that is challenging. I would also say that there is a challenge related to the size of our investments, because we invest small ticket size, and in our funds as well, the funds are quite small tickets for some potential institutional investors. And with the small ticket size of our investment, we have also a high cost for making such investments. And the total size of the funds that we are managing are quite on the low end, and therefore not always attractive to institutional investors. So I would say these are currently the main challenges that we encounter. And in terms of lessons learned, I think the way we seek to counter those challenges is to develop some blended finance mechanism currently by de-risking the private sector investment with a first loss tranche of public or philanthropic nature. And typically the government of Luxembourg, for instance, has invested in the first loss of the ABC fund, which is a fund that we have launched under a mandate of IFAD, to invest in agribusinesses in developing countries. And we think that this is a very important solution to attract private investors that would be still a bit reluctant to go into those geographies otherwise. Also, another lessons learned was to try to aggregate and to provide some mechanism to aggregate several funds to get to a certain scale that would be more attractive for institutional investors. So that's also something that we have recently launched. And we are also exploring the issuance of flexible notes programs with tailor-made maturities that are matching the investors' needs better. So this is the way we are currently trying to learn from the challenges we encounter.
Thank you very much, Marie, Shade, and Andrea. Thank you for all your contribution. It was very interesting and inspiring. I wish we could keep discussing this much longer. However, I'm cautious of time, so it's time now to move to another topic that I would like to cover today. Stay here. I will have a last question for you all. So the fact is that as the demand for ESG-driven impact investing has increased, also the numbers of initiatives, frameworks, standard reporting systems and tools have considerably increased too. So investors and financial institutions are now exposed to a complex and rapidly evolving setting, which I would like to further explore with Adriana and Claudia. Adriana, as the head of advisory team at Innpact, helping the structuring of impact finance funds, which initiatives, frameworks, and standards are being used by your clients, and why do they choose them?
Yeah, thank you, Nicoletta, and hi, everyone. You said very well, an increasing number of initiatives. I think we heard so many acronyms, and at Innpact, I think we have analyzed and worked with more 40 frameworks and standards and principles. So it's very frequent that fund managers, investors get confused on this whole universe of standards. And so one key, let's say, lesson learned and advice that we learned at Innpact and how to navigate this universe is really to think first of the use of those initiatives and frameworks. So the first question that we should really ask ourselves is, for which purpose should I use this specific standard and frameworks? If I, of course, see that that is needed, that is required by investors or regulation, and so whether I need it for risk management purposes or for doing a due diligence or for positioning the product. So I think we've seen in the presentation of Diane, she said she explained how the operating principles are really a good tool to design an impact management framework, but also to position the product as a framework to make sure that investors know that by investing into a product that is a signature of the operating principles, that is a true impact product. So we've seen that for the operating principles, but there are many others that can also help. I can name some of them because of course we just have a few minutes today, but in the industry we have, for example, the impact management project, an initiative of a number of players that helps a lot to actually define the strategy and design specific scorecards to assess the investment, and it's very concrete, very useful, and you can find many examples on this platform on how to use the scorecard. We also know the Sdg Impact Standards for private equity funds, for bonds, for enterprises. This is very helpful to, for example, design your governance and management framework in the idea of having an SDG product. We've seen also in the presentation of Neil the IRIS Plus, the joint impact model. So IRIS Plus is a very useful catalog of indicators that you can just go and identify indicators by just selecting the theme or the SDG, and so it really facilitates the selection, for example, of KPIs. We are all aware of the PRI, the Principles for Responsible Investment, that are very much used by also by private investors and asset managers, and also there are many useful resources about due diligence questionnaires and investment strategy documents. But what is also, I think, important is not to forget the tools and the initiatives that you can use for more complex activities, such as risk management. Now with regulation, with Sustainable Finance Disclosure Regulation, SFDR, and taxonomy, we see how important it is to measure and manage environmental and social governance risks and impact risks. So there are already standards and frameworks that help that way. One clear example is the IFC performance standards. These are standards to actually manage, identify and manage environmental and social risks. There are many others, and there are also tools that have been developed that are for free by the DFIs, such as the one of FMO and the one from CDC. And these are toolkits that really help a lot the fund managers to actually do proper and robust due diligence on ESG and impact, to assess the risks, have a risk matrix, have templates. So that's really my advice and my recommendation for people that are lost in this universe of standards. First, think of the positioning of your product. Is it an impact product? Is it an ESG following the regulation, SFDR and Article 8, Article 9? Is it really a pure impact product? And then think of course, the requirements of the investors. We know that the FIs typically ask for certain standards, such as the IFC, the World Bank Safety and Health Guidelines, the ILOs, and many others. Private investors might be more focused on SDGs indicators, of PRI and others. So think always of course, of the investors and the regulatory requirements, and then break down, as I said at the beginning, the use of each standard and framework. Do I need it for risk management? Do I need it for due diligence? Do I need it for fundraising? And so this methodology and approach will help you a lot in navigate and understand the use of those standards and frameworks.
Thank you very much, Adriana, for this high-level but complete overview. Now I would like to cover the academia perspective with Claudia. Claudia, you are a researcher focused on sustainable finance, carbon footprinting, and energy economics. Based on the latest article you have issued measuring the sustainability of investment fund, that for the audience, you should find it in the chat, which tools are available to measure impact and track progress, and what are they mainly used for?
Thanks, Nicoletta. So I can echo what Adriana said, which is that, or confirm what she said, that we did feel lost in terms of all the different methods and frameworks that are out there. So what we did in our article was review all of these different methods and frameworks, and we started by categorizing them. So basically the first level we did was those that are focused on climate change and those that are focused on sustainability more broadly. So when it comes to climate change, there's really two different ones that we see often. Either it is a carbon footprint type of tool, or it is something that has to do with alignment with low carbon pathways. So carbon footprint would be, for example, the True Cost Scorecard. This alignment with the low carbon pathways would be the Paris Agreement Capital Transition Assessment, so PACTA. Then when it comes to measuring sustainability more broadly, we identified three types of methods. So first, there's the ESG ratings that we have all heard of now, the sustainability labels, and then the topic of today's discussion, the sustainability impact assessment, so more impact investing. Now, the pros and cons for me of ESG ratings, I mean, it has the appeal of being quantified, of feeling very comprehensive, but you have data, you rely on self-reported data, you use a set of weights, and that those weights are not visible to the user. So you don't really know how this ESG score has been constructed. And by varying your weights, you can come up with many different rankings for the same companies, for example. So it is not my favorite type of method for assessing sustainability. Then, just to mention, a sustainability label would be, for example, the Nordic Swan Eco Label, or the labels by Lux Flag. So these are they go a bit more in depth. And finally, when it comes to impact assessments, like Adriana said, you could have some that are related to the SDGs. There's one, for example, put out by the Cambridge Institute for Sustainability. Then you could have impact assessments that are based on life cycle assessment. So you want to look at the whole value chain. And this would be, for example, the net environmental contribution, or NEC, put out by Qantas, or biodiversity footprinting from Prey Sustainability. So just to, what we did when we had all of these different tools, we rated these across 7 criteria. And the criteria also, we had come up with not just, what do we think is important, but what do international bodies think are important? So the UN, the UNPRI, UNEP, OECD, and again, we always saw the same criteria. First and foremost, of course, double materiality. So is this just, you don't want to have just risk assessment, you actually want to go to positive impact generation. Are the data third-party verified? Does it consider the life cycle perspective? To me, this is, obviously coming from the life cycle sustainability team, this is very important. And I'll just note one piece of research that was unearthed recently. So between 1995 and 2005, greenhouse gas emissions embedded in the supply chain of industries grew by 87%, while direct emissions increased by only 47%. So over the past decade, 2 decades, we've seen emissions in the supply chain increase, and not so much from the original company or the headquarters. So the other criteria are comprehensiveness of impact categories. So is it just one impact or several? Does it link to science-based targets like the carbon budget or the SDGs? Is it forward-looking? And finally, do you account for investors' additionality? So does the metric quantify the engagement and activism of the fund manager towards achieving impact?
And Claudia, all the audience is curious now. What were the findings of the report then?
So no existing framework really hits all of these criteria, but impact investing, impact assessment really was performed the best. So we found that PACTA, True Cost Carbon Scorecard, they did well. Qantas Net Environmental Contribution did well. And for me, just to echo what Sade had mentioned, that the rigor and the measurement, this is the biggest challenge, and I agree completely. So I want to see something where you can actually, we need the impact assessment to be standardized so that you can, you don't just want to know whether a fund is green or not green, or generates positive impact or doesn't. You want to know how green is it, how much impact is positive impact is generated, and you also want to know how bad are the non-green funds, right? So because ultimately we want to shift money around to those companies that reduce emissions or generate positive impact, and away from companies that actually generate emissions. And so quantitative information for all funds is really essential, because ultimately I want to see the performance in terms of euros, but also tons of CO2, for example, right alongside each other.
Thank you, Claudia. Lots of ideas for improvement. So focusing on measurement and reporting side, Adriana, what is your experience from the market? How does your clients measure impacts?
Yeah, that's a big question, but I would just want to say maybe a few key points that we've seen for most of the clients. First of all, often clients start with the assumption that they need to define KPIs, and so the question is more focused on, do we need 10 KPIs, 30, and at which level? While it's very important that we always go back to the strategy. I think it was also mentioned at the beginning of this panel discussion. Really, first step is define the strategy, the objectives, on the related to the timeline that we have. So what are the short-term, medium-term, long-term objectives that we have, and so that it's very clear for every product what is for example, if we have as an objective increasing employment or the decreasing gender salary gap, that we have a specific idea of the timeline. So setting targets, being rigorous on the strategy. And I see in the chat box we have a gender lens fund managers, and typically for gender, for example, we see now how the investment universe can be wide, and so how important it is to look at gender perspective and breaking down into the various themes and strategies. Is it about employment, about leadership, about designing products for women, and in this area we have the Twix Challenge initiatives and others that really doing a great work to clarify the strategies and the related KPIs, of course. The same we have in access to finance and microfinance with as the social performance task force, Alinus, the same we've seen before with the joint impact model. So and so it's first really key to work on the strategy, then think of the what we call direct versus indirect impact and the various stakeholders. So if, for example, we are a private equity fund, we need to think of the impact generated for the companies where we invest, but also for the communities, of course, for the environment, the impact for the investors. And so really think at the various levels and not just stop at one level, but be again clear and transparent of where is the impact acting, because otherwise we again risk to go into green washing or SDG washing by saying that we want to achieve many different goals and without giving a concrete idea of where the impact is. So once we have all this, then we have the baseline. And so for clients, it's really important to define this baseline and define it for each investment, for each deal, but of course also at portfolio level. And this really depends on the sectors and the strategy of each product. There are certain products where you have very different sectors, very different projects, so it's not possible to have a uniform impact theme for the whole portfolio, but you might work on bottom up on with the specific deals. And then this baseline needs to be, of course, aligned with SDGs, with the targets and investor requirements. And then what really helps our clients is to have tools that can help in the measurement and also in the monitoring and reporting. So tools, data platforms that can help collecting data, but can also help preparing the reports on quarterly basis for the investors or annual basis for the public to produce the annual impact report. So thinking of the various data platforms and tools that can help on the measurement, monitoring, and reporting. And by selecting this tool is also important now, again, sorry to go back on the regulation, but to think of SFDR and taxonomy, because now we need to measure adverse impact, while before it was very much focused on measuring the positive impact on what we want to do on the positive side. But now we have a number of indicators, number of KPIs also on the negative impact that we need to consider. So in order not to create really a burden on the investees, but on the fund managers as well, it's important to think of tools and methodologies that from the baseline can really look at this universe of information and data that is needed. And then one other, I think, key point that we've seen in our clients really can make the difference is the feedback and the importance of going back to the measurement system and actually see whether you are achieving the objectives. If not, maybe you need to change the instruments or change the objectives or review the strategy more in general. And at the same time, really work a lot with benchmarking. So it can be benchmarking with the similar investees investee companies or funds. It can be benchmarking against the country where you invest, or any other benchmarking you can do. But for investors, it's very important, and we see now more and more with cases of again greenwashing and stating impact that is not true. That it, of course, is important, the verification, the assurance, and all the things that we said, but really to do an analysis of benchmarking impact performance, and not just look at the impact that I'm achieving with my specific product and investment.
Thank you, Adriana and Claudia. Lots of food for thought for the Q&A, I guess, because now I see we are a bit running out of time. So I would like to conclude and to bring up all the panelists. So the Adriana, Marie, Sade, Andrea, and Claudia. And I have for you one last question on the future of impact investing. So my question is, how does the future of impact investing look like for you in 10 years? Andrea, would you like to start with the answer? 1 minute to answer each, please.
Okay, I will be very short. Okay, I think the main challenge will be to harness all the additional capital that we have been talking about and actually connect it with these impactful opportunities that have been mentioned today. To do that, what do we need? I think 3 main points, all of which have been talked about. One is the common metrics, the supportive regulation, and then finally also the opportunities, the investment opportunities. So these are the key things that I think need to happen to get us to an impact investing landscape that will be even larger and more impactful in the future. Thank you.
Thank you, Andrea. Marie, would you like to continue?
Sure. So for us, we think that impact investing will really become part of the mainstream ecosystem, and we think that there is no way back, and it's going to grow quickly. We think that public-private partnerships will be key, and we see a lot of international NGOs and UN agencies that are seeking to join forces with the private sector, and we see this as a great development because all parties bring complementarity and different capabilities. So we really welcome this trend. And in terms of element that will be key as well, we think that technology will also play a strong role and will be probably the backbone of many impact business models, especially in microfinance, healthcare, education, agribusiness, and energy, where we are operating.
Thank you, Marie. The future of impact investing in 10 years' time. Claudia, what's your thoughts?
I can only echo what they've said, and I always like to, I think impact investing will have to become mainstream because as a researcher at LIST, I also have the opportunity to look at how, for example, Luxembourg needs to look like in 2050 in order to become carbon neutral. And it is astounding and shocking to really plan out the whole economy in this way. So for example, Luxembourg, also the United States, we have an average carbon footprint per person of about 15 or 17 tons of CO2 equivalent per capita per year. Now, what do you think is our target to meet the 2 degrees Paris Agreement scenario? We're at about 16 now. We need to make it all the way to 1.6 tons. It's a drop by 90%. So if you have this in mind, you know we can only achieve this if we go with impact investing. So we cannot get there if our only goal is to simply no longer invest in the worst performing companies. We need to invest in companies that have an actual positive impact. So I hope that the future will be 100% impact investing.
Thank you, Claudia. Adriana, what is your answer?
Yeah, needless to say that I agree with what Claudia said and all the others. So being impact investing becoming mainstream, but and more actors, different actors coming into the market, more transparency also because of the regulation. But I think what we need to remind ourselves here today is it all really our role in all this, because we are in impact investing already since a number of years. So if you really want impact investing to become mainstream, if you really want SDGs in 2030 to be maybe not achieved because it would be too much, but at least to get closer to the targets that we have, then we really have the responsibility to work on the barriers that are still not enable all the mainstreams and retail investors and other types of investors to come into this market. So I'm very positive that we will get there. I'm very positive also because, as Andrea said, the panel of women can definitely drive this industry into something positive, but we really have the responsibility to make it happening.
Shade, how does the future of impact investing look like for you in 10 years' time?
I think other panelists have really touched on, the most important things. Of course, scale is going to be important, and that scale is going to be driven by regulations too. So we've seen, if you're in the EU and as a mainstream institutional investor, not just me, that I focus on impact investing, but all my other colleagues in different divisions are really thinking about what the taxonomy and SFDR means to their strategy. And when you think about the taxonomy in particular, the taxonomy is the EU using its influence to channel finance a certain way. And isn't that really about impact investing? They've looked at a set of sustainable activities that believe will help them meet that transition as when it comes to climate change, and they're using their influence as regulators to, through reporting, soft and hard powers to channel focus a certain way. So the scale for me, very well said, scale and mainstreaming. The other thing I can say is that 2030 question. We're going to start being asked to show proof that all the things we've been doing, all of these activities, all of these initiatives, all of this money actually means something. Because, when we start to talk about 2030, whether it's for the SDGs or broader climate ambitions, this is not the first time the world has tried to solve something. I grew up in Nigeria. I remember hearing no hunger by a certain age, no this, and the world was going to be this perfect place. But I think we're now working with a set of generations that would hold us more to account than we probably held the people before us to account. They believe fervently in solving these challenges, and 10 years time is quite an important milestone. What has changed? Are we on a positive trajectory, or is it just another business as usual? And what does that really mean for the world if we still, if we've not solved climate change or reduced poverty? What does that really mean for the world? Those are the questions we'll have to answer. So hopefully, this group of women, all the other participants, everyone that's joined this, we're here because we're really intentional about the change that we want to make. And, fingers crossed and positive, but we'll be tested.
Thank you very much to all of you for being with us today and for your contribution and insights. Now it's time for the questions from the audience. So the questions can be addressed on the chat to all the panelists, including Neil and Diane. Also, please note that if you have questions regarding the independent verification required by the Impact Principles, Christina Leon-Huvud, CEO of Bluemark, an independent impact verification company, is joining us for the Q&A. She's also shared the report in the chat. Thank you, Christina, for being with us today. So I spotted a few questions that have been already, let's say, written in the chat. So I will start with the ones I've seen. So I will read it out loud, and then we'll see who of the panelists will be happy to answer. So the first one is from Maria. Which countries in the emerging markets do you see as being the main focus for investments to date, current trends? I don't know if one of the signatories or who would like to answer this question.
I mean, for Bamboo, I can answer quickly. We have a strong focus on Africa, and the challenge we have is to go to the least developed countries, and we have dedicated a fund to those geographies. So for us, it's really the next step to go to countries that are more difficult to invest in. Typically, we just invested yesterday in Mali, and we try to invest in those countries that are much more difficult to invest in rather than Kenya or Côte d'Ivoire, where we have already done a lot of investments. So really for us, the goal is to push the boundaries and try to go to the most difficult geographies and also to the most difficult areas within the countries, and we try to address last miles communities' needs and go to those very remote geography within the countries.
Sade, do you want to add something?
Yeah, maybe I can supplement. So we're working on a fund that is, as I mentioned, it's a healthcare and financial inclusion fund. And the very objective of that fund is, particularly on the healthcare side, to take existing solutions or to invest in innovations. And you know that there's a lot of innovations in healthcare, but the real problem sometimes is access to that. And to make sure that whatever we invest in, we use a range of mechanisms, whether global access agreements or partnerships, to make sure that they reach LMICs. You know, we don't really judge a success unless we take an innovation, whether it's an innovation to stop bleeding that's being used in the US, and make sure a woman in Nigeria, a woman in Rwanda has access to that. So while I won't look at I won't mention specific countries, it's a general mandate to go to underserved LMIC countries depending on different challenges. The issue is that to succeed, there's a lot of collaboration that we need. We need to collaborate with companies, we need to collaborate with regulators, but we have kind of a general for this particular fund. The mission in order to succeed is we have to transfer benefits from developed to developing countries where there's a real need. And whether we choose India over Nigeria would depend on a number of factors, including, you know, ease of getting into a market, who we can collaborate with.
Thank you very much. Just a little note for the audience. So we are running a little bit late. We will, I suggest if the panelists agree, we stay 10 more minutes to cover the questions. The webinar will be recorded. So in case you have another commitment, you can then watch later on the recordings. Thank you very much. So the question here in the chat I see is on principle 3, and I guess it's for Marie and Sade. So principle 3, contribution of the investments to achieve impact. Natalie is interested to know main rationales, main arguments used to state contribution, and what are the difficulties you have encountered?
Maybe I'll go first. So I actually agree that this particular principle required us to take a step back and really decide what are our real contributions to the businesses we invest in. Of course, the easiest thing for us is our capital, you know, and we're very happy to clearly state that we provide, you know, capital. But we just, you know, but if you're AXA IM, you provide capital every day to a range of businesses. We have to consider what makes this particular capital special. This particular capital is special because of the stage of businesses we invest in, the places that we go. We're probably, even though we're mainstream investors, we're probably that mainstream investor that provides at-risk capital, that we take a risk. We're willing to take a risk that people may not necessarily associate with mainstream investors. But beyond capital, we bring the knowledge, the influence, the collaborative ability of a mainstream institutional investor with a very large parent company. You know, we're AXA IM, we're independent, but we also have the backing of AXA Group with its own influences, and we bring that to bear in the interest of the companies that we invest in and the beneficiaries that we want to provide a change for. So those are the different kind of ways that we look at our contribution. Another one is in the very early stages of our strategy. We actually did a lot of teaching for new fund managers. You know, one of the things I find with impact investing is that sometimes we keep investing with the same people over and over again. And impact investing is about building a range of, bringing together a range of talents, and many of them will not be found in the cozy offices of London or New York. We really need to go to those markets that we want to shape, we want to change, and help build those talents, even teach them how to talk to institutional investors like us to get the capital. So that capacity building, that training is also an important part of the contributions that we make.
Thank you, Sade. Marie, do you want to add something?
Sure, I would say it's a really key question. For us, we collect impact data from our investee companies, but the challenge we have is that when we report them as the impact data of our investees. So we are not saying this is our impact, we are saying this is what our investees have achieved in terms of CO2 emissions avoided or jobs created or those different impact areas. So the challenge we have is to figure out what is the contribution that Bamboo has catalyzed in the job creation or the CO2 emission avoided. And the way we are doing this for debt investment, for instance, it can be really more simple than for equity investment, because for debt investment, sometimes we are financing a project like, I don't know, the harvest of the cocoa beans in a cooperative in Ivory Coast. So here we can know exactly what has been our contribution. And sometimes we have some other investors that have financed the harvest as well. So sometimes it's not so easy. But what we will try to do with debt investment is really to see what we have financed. And for microfinance institutions, for instance, the way we do it is pretty easy. We look at the total amount of debt financing that we provide. We look at the average size of the loans that the investment partner, that the microfinance institution is providing to their end clients. And we look at the tenure, the average tenure of their loan, and we look at how many cycles of loan they can do. So in the end, the whole objective is to say, with our debt facility, we have been able to indirectly contribute to these many people having access to a loan. So for debt investment, that's the way we would do. For equity investment, it's way much more complex. And a way to do that would be to apply the ratio of ownership that we have in the company to the impact data of the company. But this is a bit, I mean, this is a bit like really a simple vision of things, because sometimes our contribution as a private equity investors goes further than just the financing. We also have technical assistance facilities. We also contribute with different ways to the impact of our investees. So I would say for equity, this is something we also do. And for Bamboo, in terms of public communication of those data, currently we are not sharing publicly those data that we estimate, because those are mostly estimates, but we include them in each investment memorandum submitted to our investment committees. And we are thinking about, how to disclose them, although these are modelizations, and to try to improve our communication of our impact in this direction as well.
Thank you very much, Marie. I have now a question, I guess, for Neil or Diane. So do you also require advised green bond SPO to mention the impact principle in second party opinion reports?
What is the SPO, Nicoletta? Not sure what that is.
Second party opinion reports for green bond.
So we don't, if someone is investing in green bonds as an investor and they want to articulate their contribution, they want to articulate and measure the impact achieved, they do have to get that data from the investee. So we don't dictate how they do it, but they can't just say it's a green bond, so this is impact. They have to get data from the issuer, the investee, to be able to then incorporate that into their impact management system. But the exact methods of how they do that are going to differ by institution. I know IFC, when they invest in green bonds, they do get that data from the investee companies. I'm not sure if others on the panel have that experience and how they do it.
I'm happy to jump in here just with a perspective from Blue Mark. I would venture to say that the impact principles are probably a fairly high bar and a stretch for many green and social bond issuers. Second party opinions generally evaluate sort of the ex ante kind of reporting framework associated with a green or social or sustainable bond issuance, whereas the impact principles require that obviously the bond issuer is managing the resulting assets funded by that issuance in accordance with that impact management framework. But we have seen a few sign on to the impact principles, and I think that's a really good sign for the green bond market.
Thank you both, Christine and Diane. I have another question directed to IFC from Arnaud. Private individuals and retail investors have been so far excluded from impact investing due to regulation limitation, except certain microfinance funds and crowdfunding platforms. Considering that retail represents around 30% of potential investors' market, does IFC or other panelists work on solutions to get retail investors contribute further in the future?
This is Neil. Let me start and see if others want to add. I think it's a great question, and I think that's, as impact investing scales up, finding ways to tap into retail investors is key to further scaling up. As I mentioned, most of impact investing today is in private markets. These are liquid assets and not well suited for retail investors. I think green and social and sustainable bonds can be a more liquid product, can fit into fixed income portfolios for retail investors, and we've issued some IFC bonds to retail investors in some countries. But I think there's more to do. This is probably a challenge more for the private asset managers to develop structures where they can tap into retail funds and then channel those into impact funds, which are aligned with the operating principles.
Thank you very much. So we have another question from Marie. How will you create a balance between impact and profitability, specifically in emerging markets where double-digit profitability is challenging? Who would like to reply?
So I'll just start quickly on that one as well, because we published a research study, or some academics actually from Harvard and others, about a year ago, where they looked at IFC's equity investments over a 30-year period, and we actually outperformed the global equity benchmarks for that period. So I would actually challenge the perception that you can't make competitive equity returns in emerging markets. These are growth markets. You have growing populations, young populations are going to be demanding more healthcare, education, consumer products. These are actually the place where the growth companies of the future are going to be. So for investors, I think there are great equity opportunities in emerging markets.
Thank you, Neil. We have a question from Eckhart in the chat. So he thanks for mentioning all the different kinds of initiative, frameworks, and standards. He's a bit afraid that some of these give a lot of opportunities for greenwashing. Adriana, would you like to reply, since you explained a bit this in the overview?
Yeah, and that's a really great question, especially now with regulation, because I think you touch very important point that the standards and certifications labels alone are not enough. We probably have seen the documentary on Netflix of Seaspiracy, where actually it's shown how the label on the sustainable fisheries is in fact hiding a number of bad practices. Now, without going into this specific example, but we've seen also examples of now fund managers that are not able to, or sometimes are struggling to check and verify that the standards, for example, the ILO's standards, are applied in a rigorous manner at every level of the investee companies and the related companies financed by the investees. So this is very critical, but I want to say that now with SFDR, there is the responsibility to check the safeguards, to check that ILOs are applied, and the World Bank Health and Safety Guidelines and the others. So it's not anymore enough to say, okay, I just know that my investee is ticking the box on this standard or this certification, but there is the responsibility of really going and check, and of course there are due diligence missions, there are evaluation assessments that can be done on the field to verify that. So it's very important, again, not to stop at at the level of applying a certain certification, but use other tools. And that's why I was saying at the beginning, think of how you use the standard, and because one standard might work very well to position and marketing, but then you need the other frameworks and a different type of work to make sure that what you state, the impact that you want to do, and the adverse impact that you want to minimize is actually happening. And so that's in the end the only way to make sure that that this happens.
Thank you, Adriana. So, well, we have another one on tools. Maybe I'll ask you and Claudia to comment here. So what are the tools that you see are being used to track progress?
I have the feeling the vote is still out. So we have SFTR. I'm kind of holding my breath, but I'm not really sure. I really want to see the numbers. I mean, I'm a numbers person, so if I could see tons of CO2 on every report, I would be so happy. And the other thing is that it's really difficult to actually get at the data. If everyone just has a PDF somewhere, huge PDFs, wonderful green pictures everywhere, I mean, it's a complete mess to compare different funds, right? So I think if we really want to open up to, you know, more retail investors, then, you know, this is what we need. Adriana?
Yeah, no, I agree. I think that's the way we can do, and I agree with all those nice reports and with the pictures and not being meaningful. I think also we see how now impact is more and more linked to financial value, and in terms of not only monetizing and making necessarily putting a value on it, but really of thinking always of the concept of financial and impact. So that's something to keep in mind in the reporting for the next years. So again, I think it's not anymore enough to just have some KPIs, SDGs, and a nice picture. So can't agree more.
Thank you very much. So I will have the last question. Then it's really late. So please, if anyone would have any other question, they can reach us later on. So the last question I have is why? So Bamboo has recently signed the impact principles. The question is why Bamboo decided to sign the impact principle. I guess, Marie, this one is for you.
Sure. Well, it's true. I mean, we have managed impact investing fund for 14 years, and what we found very interesting in the impact principles was that they were setting guidelines for impact management, and especially to have guidelines at each step of the investment process, which is very important for us. And that's something that we were doing, but it's great to continue to improve with the impact principles, and also to see that the principles will create some harmonization, hopefully, in the way we are doing impact management. So yes, for us, it was really a question of aligning our commitment with our practices, and yes, because we were already doing a lot of those principles, to become a signatory was totally a natural step. And yes, we joined recently, but we will definitely provide our disclosure in terms of how we align and do the independent verification. And in the past, we have done an independent verification that was a bit different with the GEARS rating, for those who may know them. And here the verification was more on the impact performance of the portfolios, which was very important as well. And we are switching now to doing verification of the impact management processes, which is very interesting as well. So we really welcome this other opportunity, and we look forward to continue to improve thanks to the principles.
So thank you very much to all of you for your contribution, insights, and let's say example on the ground. It has been a great pleasure to moderate this panel. So stay tuned to the LSFI channel. We will have more interesting webinar on our, let's say, channels. Thank you again, you all, for being here. Recording will be available soon. Thank you very much again. Wish you a nice afternoon and evening.